We have completed basic understanding of option Greeks and option chain. Now it is time to shift gears towards advanced mode. Is everyone comfortable with whatever we have discussed till now? If you have any questions, please watch the video again. Almost all questions are answered. If some part is not covered, put up a message in group. If you have understood Greeks, option behaviors, margin rules, and reason behind buying far out of the money options, and if you have understood high open interest present in those far out of the money options, then understanding strategies will be extremely easy for you all. Now we are moving ahead towards understanding of strategies which can be used. I will discuss many strategies, their pros and cons. Some view will be contradicting each other as well. I am not giving you my ready-made strategy because there is no fixed strategy for me. I am giving you all logic which I use with my understanding of markets from options behavior and technical analysis. You will also be able to use your knowledge and make strategy which is best suitable for your knowledge, your personality and your mindset. I will give my preferred strategy as well without doubt, but I don't know whether it will be suitable for you or not. Best way is to make your own strategy that gives best result for you. Do you agree? Let's go then. I had said in previous session that it is better to have a directional view while trading. With option strategies, we have 66% chance of making profit with directional trading and 33% chance of profit in non-directional trading if credit strategies are deployed. We deploy strategy as per underlying market conditions. Market conditions keep changing and there are times when options are deflated or inflated. Strategy selection depends upon the market conditions, and we should select a strategy which is likely to provide greatest amount of advantage at that particular time. There are 5 different zones of volatility where option premiums are inflated or deflated. We need 5 different strategies for different zones to master directional trading. It should not be random decision based on mood. Proper strategy and rules are required to excel in any business. For a patient of tibia fracture, we cannot say आज नेलिंग का मूड है तो आज नेलिंग कर लेते हैं, या फिर आज कास्ट करने का मूड है तो आज कास्ट कर लेते हैं. Some fractures need nailing, some need plating, and some can be treated with cast. And even if we are doing nailing, all nails are not same. Some fractures need expert tibial nail, some need titanium elastic nails, some need polar screws. So these decisions are not random and they depend upon fixed factors. We cannot fix adult fractures with pediatric implants. It may work, but chances of complications are also there. Similarly, when our bias is right, whatever strategy we use may give some profits, but profit may not be as expected, or it may backfire in some cases also. Sometimes excellent results are also possible. With experience, we understand things gradually, where things work and where they don't. Each trade has many components. First, we need a bias. We have discussed how to decide bias from option chain analysis. We will also discuss some basics of technical analysis, which will help you determine at which place you should look for directional bias. Second thing we need is strategy, which is suitable for underlying market conditions. And third thing we need is courage to take a trade and courage to accept the loss. Fourth thing we need is experience. We can get bias and strategy from others, but courage and experience cannot be transferred. These two are most important factors for being successful. These are directional trading strategies, which are single leg strategies like long call long put or short call short put. Then multi-leg strategies like vertical debit spread, ratio spread, butterfly, synthetic position, vertical credit spread. So these are different names. We are going to study them one by one. Out of these strategies, long call and long put naked strategies are not recommended in Indian markets for positional trading with targets expected in more than few days to few weeks. Naked option buying strategies are good only for rapid momentum in Indian markets. Knowledge of option Greeks does not allow us to buy any option which has expiry of less than 90 days minimum and does not allow us to carry that beyond 60 days to expiry. Indian markets do not provide such options in stocks. However, we see rapid moves in Indian markets where option premiums increase multifold and we may get emotional in trying option buying. In these times, remember one thing. Return on capital is more important than return in particular trade, and repeatability of process is very important. If we buy some nifty weekly option worth 100 rupees and it becomes 500 rupees, it is giving 5 times return on capital. But if it becomes 0, then the loss on investment is also 100%. If it becomes 50 and we exit, then loss on investment is 50%. And how many people can really wait for premiums to go till 500? Mostly people will exit with 40 to 50 points gain or at the most 100% gain. Then how much capital is deployed in these trades? Many people don't even give it a thought. It is random decision for them. Sometimes they buy 2 lots, sometimes they buy 4 lots. It depends on mood. Believe me when I say option buying is not good for Indian markets. If you want to buy and hold for big targets, better is to go ahead with cash trade. They will give better returns without worry of erosion of premiums. Most option buyers take intraday trades or buy today sell tomorrow kind of trades. If you have confidence in your momentum picks, then it's not a problem. On the other hand, credit strategies can be carried for a long time because they give profits for holding with patience apart from direction. Remember, return on capital in terms of percentage and risk on capital in terms of percentage is important decision making factor. Now let's come back to strategies. Single leg strategies are basic strategies, and if we understand these properly with implications and fate of each one of them, then understanding different strategies will become far easier. One leg strategies are long call, long put, short call and short put. Every multi-leg strategy is combination of these trades. So we will spend time in understanding these thoroughly. Rest of the job will be easy for us. In single leg strategy, only one type of option is bought or sold. Means either of calls or puts of single strike are bought or sold as one trade. Other helping hand is not taken. Long call and long put are debit strategies. Short call and short put are credit strategies. We will start first with single leg strategies.